So today, for those who don't know Adam, Adam is well. First of all, Adam, you are a millennial, right? Considering that I see your expertise in terms of the your beautiful websites, and I said you sent me a blog post the other day, and I said this has got to be the most like I hadn't read it yet, but I said I looked at it and I said this is the most visually pleasing web post I have ever seen. So it's absolutely just beautiful stuff. And as from someone who has to write and do those things, I really appreciate it. But for those who don't know, Adam kind of focuses on the COT, the Commitment of Traders report, and that's how I first kind of came upon your stuff. And
Yep.
I know you. And for those who don't know what a COT is, it's basically shows whether the speculators or the hedgers are long or short a particular commodity. So you've been kind enough to produce a slide deck for us with some of your information and stuff. So I was just wondering what's on your mind and what you want to talk about today.
Yeah, for sure. The whole thing about, COT is I think there's more nuance to it than, at first glance. A lot of people look at a COT report, and for example, what you're looking at is this shows basically different trader categories like, money managers or commercial hedgers, and it shows how many contracts, how many futures contracts they are long or short. And the whole reason why I started working with COT is because years ago, between my sophomore and junior years of college, I wasn't like 100% sure if I wanted to go into finance. So I took a year off and I worked for a fund, and it was a small CTA. And on like the first day, he looked at me and he was like, "Hey, I think the COT report matters. Like, I want to be able to see how other traders are positioned. The raw format on the website is really ugly. So let's make this look pretty. Let's make it actionable, right?" And so that's what I did. That's what my website, which is free, basically does. And the whole thing with COT is this: is that you don't just need to know, current positioning. You need to know whether it is extreme or not relative to the past. So, for example, with this chart on the screen right now, like a current report, yeah, I mean, maybe you see that money managers are leaning really net short corn, but you need to know if that's historically extreme or not. And some other things to know quickly before we go to the next stuff is that, like, there's some very common pitfalls I see time and time again with COT. Probably the biggest one is just looking at nominal positioning, aka just like the number of contracts. And so we've all seen that very scary chart rotating on Twitter, which is the spec position in VIX futures, right? And it's a chart that
Yeah.
sort of, it hugs the zero line for forever, it explodes downward. The takeaway is get scared, everybody's short VIX. And the reality of it is that VIX futures, pre 2004, they didn't exist. And for basically 5 years, nobody traded them. And so if you're just looking at nominal positioning, it's going to be this minuscule number because it was a very small market. But the market has massively grown. The open interest went from 50,000 to 500,000, and therefore, just the total position sizes are bigger. But that doesn't necessarily mean that people are running more concentrated positions. And so I think that's the first main issue, is you have to scale positioning by the size of the market. So it's sort of like an accurate read. And the second thing is that I think too often people like apply COT analysis, sort of like a blanket across all markets. And the truth of it is that it's really relevant for some markets and that it's less so for others. And the answer is that, futures are the primary sort of vehicle or, exchange for commodities, right? But when it comes to stuff like bonds or FX or stocks, futures on those contracts are a sliver of the total market. So, for example, if you're looking at COT data on currencies, that is completely ignoring like the spot FX market. And then also with like bonds, let's say you're looking at positioning for like the 10-year note, that's only showing that isolated contract, and it completely ignores, people spreading twos, tens, et cetera. And so I would say that personally, you should assign more weight to COT for the markets where that's sort of like the entire market, like commodities, and maybe sort of discount it a little bit for the financial stuff. And then I would say third thing about COT really quick, which is everybody's gut reaction to seeing COT data where like, specs are super short, super long, is to fade it, right? Because you hear, oh, traders are super long WTI, I'm going to, flip it other side of the boat and be the contrarian in the room. But you have to think about whether that makes sense or not, because ultimately crowded positioning does not resolve itself until people have a catalyst for actually liquidating their position. So, for example, I think it was 2017. People wrote about WTI being this super crowded long for forever. But like, put yourself in the mind of somebody who was long crude. Like, it was, it was steadily grinding higher. They were not under pressure. So regardless of like the positioning size, people were in the money and didn't have an incentive to liquidate. And so to me, with not just COT data, but any sort of positioning data, it becomes most relevant when you can sort of combine crowded positioning with price action that is putting those people under pressure and actually forcing them to, run out of the theater when like somebody else fire. And so to me, extreme positioning isn't enough. You have to sort of contrast it with, okay, is price action like helping them or hurting them? So anyways, that was just sort of like main three pitfalls I think people should know. But let's dive further into the graphs and such. So this next chart is, so this is still the same commodity. It's corn, but it's showing you that net, money manager position as a percentage of, actually this is showing in dollars. So what I'm doing is I'm taking the net position, I'm multiplying it by the front month and then by the contract multiplier. And the whole point of this graph is just giving you some context, right? So like, is positioning historically extreme, yes or no? And the answer is definitely yes for corn. Traders got really, really bearish on corn over the past few months, and you can see how that has not worked in their favor. And recent price action has definitely been hurting people who have leaned heavily into short corn. And then we got some other stuff, I think, like what's next? We got, okay, so this is the metric I made a site out of, which is all it is a 5-year percentile. So it's taken that net position, scaled by open interest, and then scaling it into a percentile. Because, for example, let's say you come to me and you say, okay, traders are net long 20% of the open interest in palladium. I don't know, like it might sound like, they're sort of long, but I don't know the actual historical range of that number. So I sort of normalized the positioning across all the contracts with a percentile. Other people do this with a Z index. It's very similar. And the easy way to, the reason why I do it is because basically if you're at, 100%, it means that category, hasn't been that net long over the past 5 years. And if they're at 0%, it means that they haven't had that low of a position. And so it's an easy way to sort of cross compare, across contracts. And
right.
so,
like Adam, I'm gonna jump in here because I just wanted to point out to everybody, it's Kevin here, and this is the example of the terrific charts that you can get on Adam's site, and you can get this for free. And this analysis is done on your website. Why don't we, while we're talking about this, why don't we tell people where, if they want to go do their own analysis on different commodities, where they would find that?
Yeah, for sure. So all the charts are completely free, and it's at freecotdata.com.
Right. And this is the kind of charts that you can get there. And it's been a great resource, and I really highly recommend that everybody go there and have a look at it. I was laughing when you told the story about the VIX future. I couldn't help but think to myself, but that isn't the VIX future all the guys that are short? That would be Patrick's favorite website. They would post that all the time.
Oh, for sure.
And the fact that, the zero hedge, that's the kind of stuff that they'll post, and you don't realize that just looking at it, there's a lot more to it than just kind of looking at the absolute numbers. The other thing that I think people don't kind of take into account, and I'm so happy you did it with the corn, is the dollar value.
Yep.
Because you can't just put it in contracts. Like, for example, WTI, when everybody is long, when the oil is $110 versus when it was 25, it was a lot different.
Yeah, it should be even double, triple, quadruple the amount, right?
Yeah, for sure.
Right. So looking at it, so I think that this is an interesting way of looking at it. But I interrupted you, Adam. Why don't you continue on with your with the different charts you have for us?
No, yeah, no worries. Let's see what we got next. After this one, we got, in fact, speaking of WTI, this is where positioning stands with it. And now this is showing on that left-hand side, you can see this is the percent of open interest. So like right now, specs are net long. What is that? 20% of the OI, which is, it's definitely up there. But remember, it's like you can't stop the analysis there. Like look at 2017, WTI specs were very long for a very long amount of time. And it didn't really matter until WTI started puking, putting them under pressure, and then it was sort of like a rug pull, and they sort of ran for the exits. And so honestly, recent price action in WTI, that definitely does put the consensus, net long in WTI under pressure.
Right, right.
And then let's see what we got.
And yeah,
Okay, so this is yen. This is probably the most interesting FX chart to me in that it came back a little bit recently, but this has been sort of the one currency against the USD where specs were like uniformly quite net short. It was honestly this and the Swiss franc, and so there's sort of like that common thread of safe haven. And this was sort of interesting to me. And Horseman Capital has written a lot about the yen being, fundamentally undervalued, and they've got some interesting reading there. And so when you start to combine, credit short positioning, fundamental, undervaluation, et cetera, then you can sort of form a thesis.
Okay,
So,
so actually, let's. Oh, sorry, Patrick. I didn't mean to kind of
Yeah.
cut. We both jumped in there because we were excited about it. So,
Yeah, I am- sorry.
Horseman Capital. They've been talking about the yen being undervalued. Like they think that it's headed higher.
Well, so they've written a lot about Japan, and when they've talked about, the currency specifically, they talk about how it would really be a bad thing for all the Japanese exporters if the yen sort of started to trade a bit richer, right? And on a bunch of different bases like purchasing power parity, real exchange rate, et cetera, yen is historically cheap against the USD. And what they're sort of saying is that like if that reverts to the mean, that is not going to be a great thing for the export-centric, Japanese economy.
Right. And so now you're arguing that there's a lot of shorts out there and that we've been kind of consistently, everybody's been shorted on the spec community. And so therefore the potential for a problem like an accident the other way with the yen rising, is that what you're kind of highlighting and saying this is a risk?
What I'm saying is basically corroborating with what Horseman is saying, in that like they're approaching it from, they've had some fundamental charts about it. I'm approaching it from a point of view, and by the way, it's always very confusing with FX futures because it's always the opposite of the traditional currency cross. This is JPY over USD, not the typical USD JPY, which is what most people look at. For some reason, the CME contracts are like this, but what I'm saying is that most traders are short the yen against the dollar, and if let's say you sort of like see the yen strengthen against the dollar, that would catch the majority of like the spec community offside, since they're sort of like leaning short against the yen.
Right.
So Adam, I wanted to just ask you, like I understand in the commodity markets because the futures tend to reflect the majority of the trading volume, but when we're talking about futures on a currency, there's often far more transactions occurring in the forex markets
Yeah, for sure.
than there are in the futures. And have you seen this cause a divergence in the data? The fact that the futures are a smaller component, is it still enough sentiment to be able to more accurately see how everyone in the much bigger picture is positioned?
Yeah, I think that in general, I've sort of watched COT and seen how it sort of correlates to other position, ways to track positioning, be it like bank surveys and stuff like that. And more often than not, it ebbs and flows in the same direction. But like I said early on, like one of the pitfalls is to read too much into COT where the contract, futures aren't the primary market. And that definitely does apply to any FX. And so it's sort of like,
Right.
I note this, but I take it with a grain of salt. But continue to what we got next. We got yen, then we got, yeah, I'll just quickly go through this. That yen chart, the previous one, that's just a 5-year percentile. So all it is scaling it based off of 5-year data. And then go to that next one, gold. Everybody likes to talk about gold. Gold positioning, there's not much to talk about. And that's the truth about COT. Very rarely is there truly extreme positioning, right? More often than not, it's just sort of like in the middle of its historical range. And that's sort of the case with gold. There was definitely a period in, mid 2018 where positioning was uniformly bearish gold. In fact, it was the first time in like 12 years that traders got net short gold futures. But that's not the case now. Traders are net long like 17 billion or so. And so if anybody comes to you and says, futures traders are offside gold, that's not really the case. I would say positioning's a wash.
Well, it's a wash here, yeah.
Yeah.
How about this chart over here?
Yeah.
This
So what
is
this
on the
does
equity
is
markets.
this combines both the E-mini S&P, E-mini NASDAQ, and E-mini Dow, multiplies them all by the contract multiplier, then puts the dollar value on it. And here's this is a nut chart to me in like three ways. The first way is that traders in late 2015, early 2016 got more bearish on US equity futures than they did in 2008, which is a crazy statistic. And then you can see what sort of happened, which is when the market bottomed in Feb 2016, they were very reluctant to reestablish that net long. It took a while for the positioning to sort of bleed away, but then it sort of like truly had a blow off top in January of 2018 when their net long position in dollars eclipsed 120 billion, which is a large number. And so, they basically went all in Jan 2018, got a little bit spooked after, Feb 2018. But then as 2018 progressed, you can see they got more bearish, and it's not like they threw in the towel, but they pulled a lot of long exposure in Q4 last year. And here's the nuts thing. Look at this. So obviously we're up, whatever it is, 15, 20% off the lows. Positioning has not come back. They're still net long, but not to the extent of, where we were higher price levels ago.
Adam, this is a fantastic chart. I think it's awesome, and it's unbelievable. If you look at this, you realize that they've sold $100 billion of stock since that period, and yet the stock market is actually higher.
Yeah.
And I fight with Patrick about this all the time because he tells me that most people are bullish and that there's all this that when I see the bearishness in the FinTwit community, I'm just looking at an elite few. And I think that this is kind of backing up my belief that there is no kind of rampant speculation in the stock market, yet it continues higher.
Yeah. And to me, it's a tricky thing of think about those people who have puked and think about if we make all-time highs, what do? So they're going to get back long. And to me, it's like, I don't know, this chart. It's a thing of where in Jan 2018, that's a true thing. That's a point in time where Zero Hedge could absolutely put out a piece and be like, hey, leverage traders are all in. This is crazy nuts positioning. That was the case then, and it's not the case now. And this is it's pretty good chart.
And actually, one second, Patrick,
I'll make it. Yeah,
sorry. I just want to point one thing out as well. You're highlighting that January 2018 kind of climax long position, but look at where it came from in 2016. They were actually net short 20 billion. So between January of 2016 and January of 2018. During those 2 years, speculators bought like $140 billion of, U.S. equity futures. And like I remember that January well. It was just madness, and it was like the just get me in. Like that's what it felt like, and your data's showing it. Patrick, you wanted to say something?
Well, I was just gonna let's circle back over here on the same chart to 2007, 2008 into 2009. This whole sequence, and what do you see there? Because to me, when I'm looking at this that data, that seems a bit of a muddle on the data there.
So it's a very ugly chart for speculators. Out. Basically, what it's showing is that in early 2009, late 2008, before the market bottomed, speculators actually sort of faded that. And they added on their net long position from like, I don't know, 30 billion to like 50 billion, right? And then the bottom fell out of the market, finally bottomed. But you can see they capitulated sort of when that happened.
Yeah.
And they were definitely caught off sides in late 08, early 09.
Right. No, see, like Kev, where I would take the opposite stance of you, and Adam, feel free to share your view on this as well. But my argument all along is very much on the camp of like the David Rosenbergs, which is actually it was January, February of 2018 that was really already the top of the bull market. And that blow off right there was just exemplifying the extreme. And all of these market highs that we've seen are just retesting those highs in what is a big topping formation. Now, maybe the S&P did poke its head a little bit of a higher high along the way, but to me, I see the fact that that blow off top in 2018 it was exactly that, and that this is in fact just the fact that the price or the orange line is consolidating is actually potentially maybe supporting the fact that there is no bull market in place anymore.
Well, Adam, I'll let you go. Do you
Yeah,
want
Adam, push back on me.
Okay,
Yeah.
so I'd say this. I'd say first off, this chart we're looking at, it is but one thing in the infinitely like complex puzzle of markets. So positioning to me is not the end all be all. But I will say this: the relationship between price action and positioning it's sort of a push pull of where, okay, let's say let's think about this. If S&P broke all time highs, what's going to happen? You're going to have people who are sort of less net long. They're less net long now than where they were at similar price levels, right? So there's going to be this like vortex of like, sucking people back in. But to Patrick's point, if you have a situation where, let's say, we don't eclipse all-time highs, and these people who were reluctant to put on long exposure, they become vindicated, and maybe that bearishness sort of infects others. And right now with specs net long, let's say 50 billion, that is, it should never be classified as like bearish positioning at all. In fact, you can see that it's historically been a lot lower. And so to me, how traders are positioned in equity futures is not extreme either way, not up or down. And the ultimate sort of thing is, if you clear all-time highs, you've got a lot of money that's probably going to get sucked back in. But if you sort of drip lower, specs can obviously just revert back to being net short like in late 2015.
Well,
Right.
Adam, you did a terrific job of not letting Patrick's bearishness affect you. Why don't you go on with the next chart there?
Oh, for sure. In fact, because I know y'all want to fit it in a window, let's go ahead and jump to the hedging stuff. So like COT, I could talk about that for forever. Okay, this is sort of a research project I did, which is we've all heard, articles being like spot VIX is low, insurance is cheap. So like, why not add on some puts, some hedges? And I sat back and said, okay, that intuitively sounds correct, but how has it actually done? And so what this chart does is it's comparing sort of three different hedging strategies. So let's say you take a portfolio that's 97.5% the S&P and then 2.5% a hedge. Now the hedge is a 6-month, 10% out of the money put on SPY. And the reason why there's a bunch of different lines is because I show different sort of strike distances, 10% out of the money, 20%, and 30%. Main takeaway there is strike selection really doesn't matter. And so what this chart shows is if you were to roll that hedge every single quarter, how would it impact both your compound returns on the left and then the whole portfolio drawdown on the right? And I would say there's sort of two things that stand out. One, which is on the left-hand side, a 2.5% hedge sounds like a very small fraction of a portfolio. But if you get a year, like let's say, 2017, where markets constantly rip higher, and you sort of, let's say you're constantly, rolling that hedge. Some people even do it monthly, but this sort of scenario is just rolling quarterly. A 2.5% hedge can vaporize 10% of a portfolio if you re-roll it every quarter and all of that premium bleeds out, right? And so the graph on the left is meant to convey, hey, this isn't just a really small slice of a portfolio. This can really be a material drag. And then the chart on the right is meant to show, okay, even if you did nail your timing, and let's say you did, allocate some money to a hedge, it's not as if it transforms, an S&P drawdown from negative 55% to negative 20%. You're still in a monster drawdown. And if you go to the chart after this sort of changes it for a bigger budget. So let's say somebody comes to you and says, okay, I'm going to run 95% long S&P, 5% in a put hedge. How's it worked, right? It has transformed the market in U.S. history into essentially flat performance. A 5% hedge budget is monster. And specifically, this is a static hedged budget. So if we go to the charts to the right, let's see what's next. The graph after this one. Okay, so this is putting some hard numbers on, okay, how has this yearly P&L in different years? So I've sort of contrasted. I got, best year ever to have a hedge, 2008, horrible year, 2013, mixed year, 2018. You can see that let's say like a 5% hedge, right, 30, 20, or even 10% out of the money, it definitely helped in 2008. It cut the 37% year-end loss into basically a 20% loss. But by that same token, it obviously cost you a lot in 2013. It transformed a 30% up year into like 11% up year. It's because with a 5% quarterly hedge budget in a year like 2013, where the market's always going up, you're bleeding a lot more than 5% total in your portfolio. The graph or the next chart, what it'll show is let's see. Okay, so a lot of people hear that analysis say, Adam, I'm not talking about, always applying a hedge. I'm going to selectively do this. I'm going to only do this when it makes sense. And so a lot of people jump to using the VIX as a filter. And they say, hey, let's say I only hedged if spot VIX was less than 15. And this is showing that 10% out of the money hedge. And what it shows is that on the left-hand side, it's sort of like in the middle of the performance between 100% long S&P, always having to hedge, and then like selectively applying it when volatility is cheap. But here's the interesting thing about it is that if you wanted to run a hedge strategy, to me, implicitly, it would have to be designed in a way that catches big drawdowns like 2008. But when you have a sort of like a cheap volatility filter, that would have called for never hedging in 2008 because volatility was always elevated, right? And so the issue with doing some sort of like black white filter for like when vol is cheap or not is that I can assure you in September 2008 spot VIX 30, assessing that at face value, volatility was rich relative to history, right? But then that 30 VIX ended up being quite cheap relative to the realized of 70 in October. And so to me, using volatility being cheap or not to sort of influence whether you're hedged or not has done a really crappy job at giving you exposure to the hedge when it's been necessary, be it '08, be it 2015, 2016, or even like last quarter. And so this is hedging based on VIX. The next one, some people say, okay, I don't want to hedge based on VIX. I want to hedge based on valuation. So let's go back one. So this is just applying a hedge, whether CAPE is greater than 25, a rich market, or less than 25. And so implicitly, you're sort of saying, hey, actually valued. Here's the tricky thing. When markets really correct, it's not as if they touch fair value and bounce. They get fairly valued, and then valuations implode, and it becomes a truly cheap market, right? And so if this would have been your hedging criteria in '08, you would have taken off a hedge well before, the October volatility because markets got cheap in like, Q2 and Q3 of '08. And so to me, these are not sort of like the data is not on the side for selectively applying a hedge based on valuations or VIX because it always would have called for sort of taking the hedge off when it didn't make sense. And I hope that sort of made sense.
So, Adam, I'm going to just ask you for our listeners to add some clarification because so when you're going 10% out of the money, not always is the hedge 2.5%. Like, are you just basically spending 2.5% of your portfolio to buying a hedge that is so just for simplicity, let's say the S&P is at 3,000, you're going 10% out of the money at 2,700. And you're spending 2.5% of your capital to buy those puts. Is
Correct.
that what you're
That's
implying?
it. So here's sort of the hedge in motion, and I should have explained this. Was like, let's say it's January 1, and let's say we're talking about the static hedge, no timing. If it's January 1, and let's say because I buy everything on SPY, if SPY is trading something like 300, you go 10% out of the money to 270 strike, and remember I'm going 6 months out. So if it's January, I'm heading out to like June or July puts. Okay, so I would be spending 2.5% of portfolio capital on the hedge and keeping that exact maturity and strike for 1 quarter. Then let's say it rolls around to the end of Q1. It's like the last trading day in March. Then let's say SPY had gone down to like 250. I would roll the strike down to 225, and then I would roll the maturity out to a September put. And so, but then you're sort of resetting the 2.5%. So like if at the end of March, let's say the hedge did really well and it ballooned to like 5% of the portfolio, then you're sort of taking profits on that, and then you're only rolling 2.5% into the fresh hedge. And then if the hedge did like really bad in the quarter, you're sort of re-upping from like a 0% to allocating new capital to the hedge budget, if that makes sense.
Right.
Yeah, Adam, that's terrific stuff. And, as a former index trader, I can tell you it makes complete sense because we used to sell that shit all the time.
Yeah.
It's always overpriced. And I think you've just done a terrific job of kind of putting it into numbers in terms of like how little that hedge works and how much it's not really going to save you when the shit really hits the fan. And not only that, it's very difficult to kind of trade it correctly. Anyways, Adam, for those who want to stick around and learn more about Adam, make sure you stay to the after hours. In the meantime, before we say goodbye to you, Adam, why don't you tell people where they can find you, a little bit about your company, what they can do, and how they can contact you?
Yeah, for sure. So main avenue is through Twitter, movement_cap. Movement Capital, that's actually where I manage, outside capital. And those type portfolios, a lot of people think I'm like super short term, like using COT for like intraday stuff. I am not that at all. I manage more boring ETF portfolios for like individual investors in the US. And that's what I do with Movement Capital. And I guess that website is movement.capital. And then, like I said, I do have all those free resources for traders. I've got the COT website, which is free, cotdata.com, which is, just positioning. And for people who like to look at seasonals, I've got commodityseasonality.com, which shows you free seasonals for a bunch of commodity contracts.
Well, thanks for being on, Adam. It's been terrific chatting with you. And for those who want to, hear more about what Adam's got to say, maybe we'll even delve into the seasonality of some different commodities. Stick around for the after hours with Adam. Thanks again, Adam.
Yeah, I enjoyed it.